What do you do? Oh, what do you do, all you wonderful homeowners out there who are sitting fat and sassy in your very low interest rate on your first lien, and you don't want to touch it, but you need money, and you need a big chunk of it, $50,000, $100,000, $200,000 for big life expenditures or purchases or investments like funding college, paying or buying down a car, paying down high interest rate credit cards, or for you investors out there, especially if you're trying to get an opportunity that's only a week or two away, you've got to have cash right away to buy maybe an investment property. I'm going to show you an incredible solution. And you've got equity in your home, but it's untapped. So this is the video for you. We're going to do a little dive into a great solution for you. So watch it all through the end. I'll have some examples as always. And as I like to say, let's kick off this rodeo right now. Hi, everyone. I'm Kevin Fagan. I am the Mortgage Patriot here in Central Texas, nestled in the hill country above San Antonio in Spring Branch, Texas, serving proud Texans and, of course, great Americans all over this country. And we're going to do another important topic because we have a weird environment, right? We are sitting here now in the middle of or late 2023, and those great mortgage rates that we had from 2019 all the way to 2021 are no longer available. But you were lucky enough, hopefully, to refinance during that time. So you're sitting on a 2.5% to 3.5% great first lien mortgage, but you need money and you need a lot of it, like I said before. So what do? We're going to talk about all that in this video. But before we do that, can you like and subscribe, please? It really helps me bring content to you as I build the YouTube channel. A lot of you great subscribers have commented all the time. So do comment and text me. I'll respond to all the comments and all the texts, asking me questions and just trying to get more information on whatever topic it is. So continue to do that if you would, but like and subscribe as well. And let's get into this content right now. So here's kind of the flow of this video. I want to distinguish between what a first lien cash out loan is versus a traditional HELOC versus what I'm going to call an automated HELOC. And then we're going to break down the criteria of the automated HELOC. That's what the product is that really I'm going to be showcasing in this video. And then lastly, what are the advantages of this automated HELOC? And then along the way or at the end, we'll have some example or two that hopefully fits your situation, and you can draw from that in terms of understanding the product better and if it can help you out. So let's get into that again right now. So a couple of quick assumptions as we roll into this presentation, and that is, one, you're a primary homeowner, or you can own a secondary home. So it applies to both primary or secondary homes in your name. And of course, that you have equity in your property, considerable equity, because whether it's the first lien cash out or the traditional HELOC or the automated HELOC, they all require, if you want to pull money out of your home, you've got to have equity to satisfy that. In most states, you can only go up to, across all three of these products, about 80%, meaning let's say you have a home of $300,000, 80% of that is $240,000. And let's say you have a first lien of $150,000. So you would be able to draw up, depending on the product, from $150 to $240. That would be about $90,000 worth of access. So that's one of the assumptions is you have considerable equity in the property. Otherwise, there's no ability to draw cash out. Okay, let's stick with that example of a $300,000 home that you own. And your underlying note is about $150 right now. You bought it 7 years ago, maybe for around $200,000. You put down 10%. The mortgage has been paid down over time over the last 7 years, and you've also refinanced it. Now you're sitting at a nice 3% rate, and you don't want to touch it, but you want money. And luckily, your home has appreciated from about $200,000 to $300,000 during that time. It's not unusual across this country right now. So what do? You can access about up to 80% of the value of the home. That's $240,000. You're sitting at about $150 on your first lien. So you have about $90,000 you can access. You have a choice. Choice number one is you can replace your first lien, your 3% first lien, but your payment on that's only about $675. If you do the math on that, just the principal and interest, $675. Why replace that with a whole new loan of $240,000 at prevailing rates, which would be about 8%? That payment would be about $1,760. So So you'd be going from about $675 to $1,765. That's a big leap. So what do? A lot of loan officers aren't going to tell you about this. It's the second lien. And the reason we don't tell you about it is because we don't make a lot of money on it. It's more of a courtesy type of product, but I'm telling you about it now because I'm the mortgage patriot on your side, right? So you take that gap, that $90,000 from 150 to 240, and you get a second lien, in this case, an automated second lien. I'll tell you why in a minute. Automated second lien to fill that $90,000 at the prevailing rates. Well, what are the prevailing rates on these standalone products? It's about 9%. So it's not cheap, but a lot better than the 1760 because at $90,000 at 9% comes out to about $725. So you take that $670 on your first lien and the $725, you're at about $1,400 versus $1,760 on a first lien, $240,000. So I threw a lot of numbers at you there. Hopefully you're not spinning your eyes, but it makes all the sense in the world to not replace your first lien, but rather to augment that with a second lien position. Now we're going to talk about why a standalone versus a traditional HELOC. Okay, so you're smart enough to keep your first lien, and now you're smart enough to know that there's a second lien option available to you in the form of what we call a HELOC. So what is a HELOC? A HELOC is a home equity line of credit, HELOC. And they come in a couple of different forms. They have this new form that I'm talking about now is the automated HELOC, as opposed to the traditional HELOC. A traditional HELOC, think of it like a giant credit card that's collateralized by your home. So in the example of our $300,000 home, $150,000 first lien, we have $90,000 of availability to get us up to 80% loan to value. That could be in a traditional HELOC. It can be a perfectly fine product, not disparaging it at all. Might work for you. I'll tell you why the standalone HELOC might be a better deal at some point. But the traditional HELOC, again, giant credit card, and $90,000 worth of availability. You don't have to use it all at first, but to the extent that you do use it, you pay it back like a credit card. You just pay it back whenever you can. There's no set payments on it. It's interest only, and there's no set payments. So you could pay it off in chunks, $5,000 every month. Pay it off in a giant $50,000 payoff. Whatever your circumstances are, pay $100 a day. Doesn't make any difference. There's no standard to it. There's no stated note to it. It's just a simple interest. Whatever is owed on it, you're going to pay on it. That's how that works. As opposed to this automated HELOC, which I want to talk about right now. And this is a brand new product across the board, rolled out about 6 months ago nationally. Okay, lots of lenders have it. It's not available in every state. Texas is one of those few that still does not have this product. Regardless, let's talk about it now. What is the great benefit of the standalone HELOC? Well, for one, incredibly fast funding. And when I say incredibly fast, I mean incredibly fast. As opposed to a traditional HELOC that you have to go through the normal mortgage process, long application, lots of documentation, appraisal. You have to wait for the appraisal to come in, high costs, and you may or may not fund between 30 and 45 days. That's a traditional HELOC. I know sometimes a HELOC can take even longer than that. On the automated HELOC, you can get money in as fast as 5 business days. That's right, 5 business days. So you fill out an application. It's all automated. If you're a W-2 worker, it's going to work faster for you because if you're self-employed, which they will accept, it's just harder to prove income. So if you got a nice paycheck every 2 weeks or what have you, you turn that in, you turn in some other documentation, you're going to get funded, you're going to get approval right away, and you get funded literally within about 5 days. So convenience is an enormous factor. Secondly, low cost as opposed to a traditional HELOC. You're going to have all the fees, what we talked about, processing, underwriting fees, appraisal fees, inspection fees, go on and on, government recording. The automated HELOC has virtually none of that, including appraisal. They do a desktop automated appraisal. So they're not sending anybody out to your property. You're not writing a check for $900 or whatever the cost of the appraisal is these days. So minimal cost, which is great. And for that matter, at closing, you're going to get a check. You're not writing a check for a dime. There's no cost per se. There's no out-of-pocket cost for you. There's costs involved, but they're rolled into that note. But you're getting access right away and in a cheap manner. A couple of the other distinguishing features of the automated HELOC versus a traditional HELOC is the following. So on a traditional HELOC, let's go back to our example of a $90,000 second lien. Traditional HELOC, you can apply for and get funded, so to speak, a $90,000 HELOC, but you don't have to receive those monies or draw on those monies day one. In other words, you could keep it, the account is there ready for you to access $90,000, but you don't have to. In the automated HELOC, you do have to access that $90,000 right away. So in other words, $90,000 in our example will be funded into your account day one. So as long as you know where that money is going towards, then that's not a big deal for some people. Some people like the traditional HELOC because they don't need the money right away, but they want it just in case. With the standalone HELOC, you know what you want that money for and you want it now. That's the big difference. The second big distinction is once you get that money, you get the $90,000, you have different pay periods that you can choose from to pay it down versus a traditional HELOC. Again, that's just a monthly interest-only type of loan. You'll pay as you go on your own terms. Here, the terms are spelled out for you. It's either going to be a 5-year payback, 10-year payback, 15-year payback, or 30, I believe. They give you about 4 different options typically. And depending on which term you take, which option you take, you have a number of draws that you can take as well. So for example, let's say you take the 10-year option. You borrow $90,000, you have 10 years to pay it back, and you have a draw period, not number of draws, draw period of say 3 years. The first 3 years of that 10-year period, you can treat it kind of like a traditional HELOC. You can take the $90,000, pay 40 it back, draw another 20, pay down 50. All during that draw period, you can treat it like a traditional HELOC. But once that third year is up, then you're set on a schedule of monthly payments. Hope that makes sense to you. Okay, let me show you by real life example how powerful this automated HELOC can be. Because I have friends in California, for example, they've owned their home for about 20 years, bought it for about 200. Their lien right now is still about 200 because they've been refinancing it over the course of time and adding to it. But their home is worth over 800, but let's call it $800,000 for this purposes of this discussion. Okay, so how much can they access? You can access 80% of that. 80% of 800,000 is $640,000. So they can do a first lien up to 640, but we've already talked about why that'd be a mistake because I actually helped them refinance into their current lien right now. They're sitting at about 2.5% loan. Don't want to touch that in the lease. Wouldn't want to. But they were presented with an opportunity where they could buy an investment property for about $300,000 if they could deliver within 10 days. Property is worth about $375,000. If they tried to do a regular HELOC or even that first lien, cash out, that would take 30, 45 days minimum. So that opportunity is lost otherwise. But again, tapping into their equity with the automated HELOC, they're able to pull out within 5 business days a chunk of $300,000 that was available to them at the prevailing rates of the HELOC and purchase that investment property for $300,000. So they bought a $375,000, $380,000 property for $300,000 only because they could produce money that quickly. They were a cash investor and cash is king. So just that example alone shows you the power of being able to access money that quickly. It doesn't have to be an investment property, of course, as we talked about. We could do any number of things. But the speed of the automated HELOC and the low cost and all the other advantages we talked about make it a great choice that fits your situation. So it's traditional underwriting, but without the appraisal, quick turnaround times, very low cost, and give it a consideration. So look down below, call me at 210 or text me, 210-317-6514. I'm the Mortgage Patriot, Kevin Fagan on your side. Make it a great one.